Today, property zones, property opportunities, or property risks. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by George Markoski. Hi, George.
Hi, Martin. How are you?
Yeah, good. Good to see you back on again, and thanks very much for sparing some of your time. Now, you're, of course, across the property market. We're seeing property prices falling. We're seeing borrowing power reducing. We're seeing listings rising. We're seeing some property investors running for the exits. What on earth is going on?
Yeah, well, look, it's crazy times at the moment. And look, we went through a period through COVID where we had very low interest rates, but high inflation, which is very unusual. But now we're getting higher interest rates and higher inflation as well. And I think the reason a lot of people are panicking is because the RBA said, hey, we're not going to do anything until 2024. Don't worry, everything's going to be fine. And then within less than 12 months, they did a 180% turn from slashing their right down to pushing them up every single time.
Yeah, and sort of interest rates, of course, will continue to rise. It's interesting, the Bank of England 2 days ago said recession is coming in the UK and they're going to have to put rates up a lot higher. The Fed's put them up. They're going to put them up again here. It's just a question of how high. So higher interest rates creates huge issues for people, right? Particularly with large mortgages, and particularly those who are leveraged, and even property investors, of course, who will have to pay those higher rates and will try to pass the rent costs on to their tenants.
Yeah, exactly. And this is the challenge because the RBA is using interest rates going up as a tool to actually reduce inflation. Now, when rents go up, that is considered inflation. So what they're doing is actually putting a bit of fuel to the fire with that sort of part of the economy, because you put rates up, they get passed on to tenants, which therefore puts it up the inflation, and it's a vicious cycle. So,
yeah, and just to make a point there's a lag effect too, right? Because of the way that the CPI is calculated, right? So the rent increases that have been the last few months will flow into the forward-looking inflation. In other words, it's going to put a further rocket under inflation into the next few years.
It's a lagging indicator, as you said, and with lagging indicators, you got that lead time, and also, you look at leases. A lot of leases are 12 months, so you've got a whole 12 months lag time when it comes to getting that data. So that makes it very difficult to use interest as an instrument. It's a very blunt instrument when it comes to reducing inflation.
Yeah, absolutely. But, it's the one that they've got. It's
and they're using it as hard as they can. It's smacking one over the head with it. Now, one thing we have to realize, though, is interest rates are still very low.
Yep.
And that's what people need to get. And I think most people are going to be fine. But there are people that are on the edge. What's happened is there's a lot of people with FOMO, that went into these hot markets and they wanted to buy an own occupy, and this is their dream home, and they did whatever it took, because what happened was they'd go to an auction, they'd miss out, go to another auction, miss out, and sooner or later they thought, we'll just pay whatever it takes. And they went right to the edge. And unfortunately, there's people that have hocked themselves up to the eyeballs and they can barely afford it. They're in principal and interest alone, and a little bit of a rate rise is going to affect them quite strongly. So I think that part of the market is very vulnerable. Also, a lot of speculators. So, people that invest in property but don't know what they're doing. They speculate. They're like, oh, my God, the market's gone up. We've got to just jump in, and they haven't structured their loan right. And those people are going to be in trouble as well, because the lag, because, you rent your property out, you still got 12 months before you can put the rent up. And during that time, interest rates go up, and therefore you're suddenly a lot more negative cash flow. So people that are very negative cash flow, that are relying on negative gearing, are going to be in trouble.
Yeah, and it is worth saying, my surveys, I measure the gross and net investment returns of property, right, for investment purposes across the country. And more people are actually getting now negative returns because, of course, the capital appreciation is going the other way because prices are beginning to slide. And people are getting quite twitchy. So, in fact, there are more property investors now saying, well, maybe I should get out because property prices have gone up. And if I wait, property values are going to fall again. I'm going to lose capital as well as revenue. It's really quite tricky. The other point, of course, is the borrowing power questions are important, right? Because the borrowing power is how much for a set income you can borrow. And now because rates are higher, the banks have actually lifted those hurdles, which means that you can borrow, 20% less than you could 6 months ago? So it really, it's crazy times.
It is. And you were quite correct when it comes to borrowing power. Borrowing power has a very strong impact on property prices. Because if people can borrow more, they will. And that's one of those limiting factors. So now with borrowing power going down, that's going to really put a damper on property prices, especially the higher value ones.
Yeah, and in fact, the latest data shows the top end of the market is tipping over first. It's also spreading out. So Sydney and Melbourne, Brisbane's now going negative. We're seeing signs over in the west. And indeed, even in places like Adelaide and Tasmania, who've been holding out, looks as though they're beginning to turn too. So the question, I suppose, is there anywhere to hide? Or, is it sometimes better just to sit out of the market and wait for this to sort of settle down? Or should you still be in the market? I think that's the question that many people now should be wrestling with. Good
question. And people ask me all this question all the time. I get this question every week. People are saying, is this a good time to invest? And I'll give you the short answer, then I'll give you the long answer. The short answer is, if you know what you're doing, it's always a good time to invest. If you don't know what you're doing, it's never a good time to invest. I think that the people asking, is it a good time to invest? What they're doing is they're speculators, right? They're going, okay, let's look at the market. Should we sit it out? Do we jump in? What's going to happen? And what they're trying to do is they're trying to predict the short-term market. The challenge with predicting the short-term market is property is a long-term game, and really it's about long-term, not short-term. And if you look at people that invest for just 1 year, 90% of people lose money. Look at people that invest for 10 years, 90% make money. So just looking at that, if you haven't got your long-term investor hat on, you shouldn't be investing in property. You should try something else. And if you've got a long-term investment hat on, then what happens in the immediate future is not as important. Getting in the market with the right structure, the right property is the most important thing, because you can keep waiting it out, but you never know what's going to happen. You don't know if you're at the bottom or the top or what's happening with property. So really, in the short term, I believe that careful consideration, buying the right property is the right thing to do, because that's the only way to make money out of property. So if you don't have property, you can't make money out of property.
Yeah, and if you don't have property, you can't lose money either, right? So it's a matter of picking the right. And I always, this is the sort of conversation I have quite often with people who sort of swing dramatically from positive to negative. The point is, you've got to make sensible decisions wherever you are in the cycle, right?
That's right.
And those decisions are about what property, what location, how much debt, how to structure the debt, and to make sure that you're buying property that has long-term value potential rather than not. Now, those are universally true factors wherever you are in the property cycle. But unfortunately, when you're in the cycle and everything's rushing up, people forget that and just grab whatever's going, right? Mm-hmm. And when prices are coming down, what you find is that everybody runs to the exit, and good property and bad property, they handle it the same. You've got to understand, not all property is equal.
Absolutely, there isn't, and it's not. And there's nearly 16,000 markets in Australia, and out of those 16,000 markets, there's a percentage that are going to go up, regardless of what's happening at the moment, and there's going to be a bigger percentage that are going to be going down. And it's a matter of trying to pick those markets, trying to stay away from areas that've got too much supply. So one thing I recently printed the no-go zone. One thing I'd be avoiding at the moment is a lot of the capital city unit markets. There's a lot of places where there's too much development. There's the developers going in, they're just expanding quite a bit, and those are oversupplied. And this sort of market, you really want to stay away from any big developments, because that's going to be the first thing that's going to happen that's going to slow down.
Well, I've been watching those apartment markets in the major centres in particular. And in places like North Ryde, for example, out in the outskirts of Sydney, huge development. And even back to 3 or 4 years ago, before the last run-up, they didn't get a run-up, by the way, prices are still lower now than they were 3 or 4 years ago in those areas. Why? Because there's been a huge increase of supply. All the same, they're cookie-cutter developments. There's no differentiation. And quite a few people bought those thinking they were going to get great returns, and they got nothing. So I guess the question is units versus apartments, and also old versus new. What's your thoughts there?
Look, depending on your tax situation, whether old versus new, the deal is the most important part of property is the capital growth. And old and new, the capital growth's similar because if it's in the same area, it's going to grow the same. Now, the difference between holding the property is the cash flow, cash flow part of it. And lots of times, new properties are easy to hold because you get massive depreciation because the government can't house all the people in Australia. And because of that, they incentivize you to actually buy brand new. And I find that buying brand new is just easier. There's a lot of people out there they're like, no, I don't want to buy brand new. I want to go get a bargain. I want to buy something old. And that's fair enough, but that takes skill and that takes time. What I want to do is get into the market. I don't want to spend too much skill or time. I just want to get into the market and let my properties do all the heavy lifting because what happens is properties double every 7 or 10 years. If you get the right property, and so if I get an old property, might get a little bit cheaper, might get a better bargain. But if I get a new property, I'll get better cash flow. And with the cash flow, I can afford to buy more. And having more properties is better than less because it keeps you safer. So a lot of people don't realize this, but having multiple properties keeps you a lot more safer than just having one that you're relying on because back in the old days, like in Venice, when Venice was a merchant town, what would happen is, you send one ship out and it comes back. And if it's gone, it's gone. So what they do is the merchants to get together and get one ship each out of 10. And that way, if you lose 1 in 10, you're only losing 10% and you make more money. So it's all about aggregating the risk and doing that.
Right. Well, there's a couple of things I want to pick you up on there. Firstly, 7 to 10 years on average, maybe, but actually, if you look over the last 50 years, not true, right? So it's been different more recently, but that was, I think, government policy, low interest rates. The question will be, are we going to see anything like that over the next 10 years? I have my doubts because I think we're going to be living in an environment of higher interest rates. Sure, migration will still be there, but I have a feeling that the capital growth that we've seen was atypical, right? Second point, just before you come in, second point is I think the point you just made about diversification and risk diversification in particular is really, really important. And so often I see people buying 2 or 3 properties in a very similar area of a similar type. And that isn't necessarily that smart, right? Because you don't get the diversification that you're talking about. And some markets may go up, some markets may go down. So thinking about diversification, and that's type of property, and even different locales, right, and maybe even different cities, that gives you a bit more flexibility and more protection too. Final point, of course, is if you start then cross-leveraging one property to the next property to the next property, which some people do, that works well in a rising market. But the reverse is also true in a falling market. That's when things really can get very difficult. So you need to be thinking about what happens when markets go down as well as up if you're going to build that sort of portfolio.
Yes, absolutely. And they're great points. I'll jump on the diversification one because I really like that one. And I totally agree. People that buy more than one property in the same suburb and same type of property is just terrible. And I've seen examples of people that have bought, 20 units in Cairns and then there was a flood and then they lost everything they had. Putting all your eggs in one basket is just one of those things you shouldn't do. And I really like to spread my investments out. And I like to invest in capital cities, large regional centres. And what I like to do with our members and our clients is, if you get one in Brisbane, or your next one is in Adelaide, next one's in Perth, and we move along that property clock and spread out the risk because when Brisbane's going up, Adelaide might be doing something different and it spreads it out, but also time spreads out the risk as well. So if I'm buying a property every 12 months, then what that does is that aggregates the property market and stops the peaks and troughs because I'm doing it consistently.
Yeah, absolutely. Well, that's how you build a portfolio, right? So you have the multiple dimensionality attached to it. And it's worth just underscoring, the demand for rental property in Australia is going to continue to rise, isn't it? We know that. We've got more migration coming in. We've actually got a higher proportion of people living in rented accommodation than we ever have in Australia. So it's not like there aren't going to be enough tenants potentially if in fact they can find properties that they can afford to rent, which may tell you something about the types of property that you should be buying if you're looking for long-term tenants. And I think sometimes people sort of think, well, is property investing over? No, I don't think it is. But you've got to be really, really much smarter because, a lot of people, I would say, made quite dumb but fortuitous decisions over the last 20 years and did quite well. I don't think it's going to be that easy now going ahead.
Look, it gets more challenging and you've got to get better with the market because there's more people investing and there's more people that are sophisticated. Now, what I wanted to touch on is your first comment about property prices. We're not going to see that 7 to 10 year growth anymore and things like that. I've been investing for 25 years, and the whole time I've been investing, we've gone, ups and downs. But I found overall properties went up, especially I guess if you choose the right ones. With the rental market, what you said, I mean, our rental stock, the amount of properties available for rent in the last 2 years has halved. That has never happened before. That's huge. And not only that, we're a lot more aggressive when it comes to immigration, and we're going to be having 250,000 immigrants a year. And on average, you have 3 immigrants, you need 1 dwelling.
Yeah, so we certainly expect the government to open the doors and bring people in. A lot of them will rent initially. And interestingly, they often come to gateway cities like Sydney and Melbourne, but then spread out subsequent. So that's another factor. But I just want to come back to this property growth situation, right?
Yes.
It's just 25 years. You're absolutely right. That was the period in which deregulation happened, right? So effectively, you had more lenders coming in, the non-bank lenders, the Aussies of this world, right? You had lending restrictions removed. You had interest rates cut. You had government incentives increased. And you had essentially the forward momentum because, of course, property prices grew, and as interest rates came down, property prices grew, and credit became more available. The question I got to ask is there any chance that you're going to see the same rate of credit availability in the next 10 years than you've had in the last 25? Because if not, I have a feeling that future growth will be nothing like what we saw. I think that last 25 years was absolutely a bit of an aberration because of what I've said. They can't go on doing it because there's a limit to how far you could take rates down and how much that people can borrow.
I understand your point, but when a country's got a very aggressive immigration policy, that has a big knock-on effect on the economy. And there's a bigger market of people investing, and therefore it just pushes property prices up. So I'm very confident that the next 10 years is going to be an amazing time to invest. And if you look at the population curve of our spending power and our curve as well, it all aligns to a perfect place. So I really think there's going to be a lot of money. I mean, when you look at it, through COVID, we became the richest country in the world. Australians have got more savings than anyone else. We're cashed up. We've got billions of dollars. We've got lots of money and big war chest. And most people have paid off their home or a lot of it, and they've got lots of equity. So there's a lot of stability there as well. It's not like what happened in America back in 2008 when everyone just fell over and the whole market just dropped. Because a lot of people talk about property corrections. And I wanted to address this because there's in the paper at the moment, they're like, oh no, there's going to be a property crash. It's going to be terrible. Now, people imagine a property crash where property just crash and they fall by 50%. That doesn't actually happen. What happens is they might correct, 5 or 10%. And that's probably a very high possibility. But the thing is, if you look at over the last 3 years in Sydney, it's gone up nearly 30%. And if it drops 10%, well, we could change the headline from property crash to 20% growth in 3 years if you average it out.
Well, it goes over what term you look at it. I agree. The last couple of years was much stronger than I expected. But again, that was because of ultra low interest rates, government schemes and all those things, right? Because they were pumping the economy like mad. That created all the inflation that we're now wrestling with. And I guess the other point to make is that if you go back to the US, if you look back in 2007 and 8, property prices did actually go back 35 to 40%. If you go back to Ireland, property prices fell 40 to 45%. Now, they are slowly recovering, and in fact, in the US, they're now above where they were, and in Ireland, most are as well. The point I want to make is that there is no one-way bet here, right? Which goes back to our earlier point, which means that if you are going to bet on property, you need to make the right bets, which goes back to the right locations, right type of property, right structuring, right debt, right debt and all of those things, right? I'm not as certain as you are about the future. in terms of growth. But what I do know is we're going to have a bigger population base. We're going to actually need more properties. We need more property for people to rent. All of those things are absolutely right. So therefore, it's not like it's a complete no-go zone, but that's when getting smart about it and making good decisions wherever you are in the cycle really comes home to roost. Because if you make the right decisions, then you stand a much better chance of winning. If you make the wrong decisions, even in a rising market, you can lose money.
Look, getting educated and learning the core fundamentals and doing it right is more important than anything else, especially in a time like this. But any time, I think you should really get it right and be sure when you're investing in property why you're doing it. Also, a lot of people don't even know what their cash flow is going to be. So I suggest, you get one of those programs like Peer, or we've got a program called, we've got a cash flow calculator we give away for free. Go in there, and what I suggest to people do is get that cash flow calculator when you're buying the property, but at the moment, put in an extra high interest rate and see what's going to happen in the future and see if it's still a good deal for you. Because don't put today's interest rate in, put tomorrow's interest rate in, because it's going to be higher. That's the fact of it. The RBA, they did this in 2008. They raised interest rates. The property market tanked. The economy tanked, and then they went through with their samurai sword and cut interest rates like crazy to make up for it. But if you look at the last 4 times we had massive interest rates go up, within 5 years, the property market always goes up around 30%.
Well, we'll check back in 5 years, and see whether it happened this time. Who knows?
Look, who knows? Like, I haven't got a crystal ball. I mean, I didn't expect Sydney to go as high as it was. I was expecting it to drop over the last few years. So I'm not always right. I just look at the fundamentals and make educated guesses, but they're guesses. No one's got a crystal ball. There's no one in Australia that knows the real truth until we experience it. But I think having an educated guess and having the numbers does make a big difference.
Absolutely. And I think the point of this conversation is that wherever you are in the cycle, there are still important decisions to make, right? Questions to ask. And I do think the cash flow question is probably the most critical one, because I see so many households who really still don't know where they are. They don't actually understand what's coming in, what's going out. Or even if you've got an investment portfolio or investment property, people haven't actually assessed what the value of that property is in terms of cash flow terms. They sort of hope that it's going to go up, and they say, well, whether I win or lose on the rental, that's not the critical thing. It's the capital appreciation. I think it's a bit simplistic. So I think it's really important to get educated, as you say, use the tools that are out there to be able to make better decisions, and then hold long term. Because the final point to underscore is when you transact, you spend a lot of money on the transaction. And by definition, if you then sort of flip it within a few months, you're not going to ever cover the costs of what you spent to acquire the property in the first place. So taking a longer term view makes it much more likely that you're going to cover the acquisition costs and the management costs and all of those things too. So there's a lot of things to think about here, particularly now.
Martin, you nailed it. You really have. And I was going to say, if you want, I can offer this tool for your listeners if they want it for free to have a look at the cash flow calculator and do their own numbers. But you're absolutely right. You really need to look at the long term. And that's what it all comes down to, having the fundamentals and investing long term. And like you said, the cash flow is the most important part in times like this, because if you can't afford it, you're going to get in trouble.
Absolutely. Well, if people want to get more information about the cash flow tool, where do they go?
Okay, so if you go to tools.positiveproperty.net/cash flow, I've got a free calculator there and also some training. It's a little Excel spreadsheet. It's very nice and simple and easy for everyone to use. It's not like a lot of those calculators you buy for $800 online and you've got to put in 5 million things. It's a really simple one. But what you can do is model what's going to happen. It shows you the depreciation, shows you who's paying, the tenant, the taxman, or yourself. It's a really handy tool, and all our members use it. And what I've been suggesting to people lately is put in the extra interest rates and then see how the cash flow is before you make any decisions.
Yeah, great advice, George. Well, thanks for that. We'll put the links and things below. I enjoyed talking with you. And, in these interesting times for property, getting closer to understanding what's going on is really, really critical. So it's a good point to make today. Thanks very much for your time.
Excellent. Thank you. Lovely talking to you.
Thanks. Cheers. Bye-bye.